The current live price for SAP SE on the Xitre exchange is €164.62, reflecting a staggering intraday collapse of minus €31.52 or 16.07% as of this moment on Thursday, January 29, 2026. The market is witnessing what can only be described as a tectonic shift in investor sentiment as the German software giant experiences its most violent single-day sell-off since the autumn of 2020. While the headline numbers for the fourth quarter actually beat analyst estimates on several fronts, the reality underneath the surface has sent institutional players sprinting for the exits. This is the classic trap of expectation versus reality. The market expected a flawless acceleration in cloud momentum to justify a premium valuation, but the reality revealed a subtle yet critical friction in how SAP is converting its massive backlog into immediate revenue. The curiosity loop for every investor right now is simple. How does a company that is technically beating its earnings targets lose over 15% of its market value in a single morning? The answer lies in a metric called the Current Cloud Backlog, or CCB. Most investors look at total revenue or earnings per share, and on those fronts, SAP performed admirably. However, the smart money focuses on the CCB because it is the most reliable leading indicator of where the company will be in 12 months. In the fourth quarter, this backlog grew by 25% at constant currencies. To a casual observer, 25% growth for a legacy titan sounds fantastic, but in the world of high-stakes enterprise software, expectations were pegged at 25.7% or higher. That fractional miss, combined with management's admission that they expect this growth to slightly decelerate throughout 2026, was the spark that lit the fuse. When you are trading at the multiples SAP was carrying yesterday, there is zero room for slight deceleration. Common wisdom suggests that SAP is the safe play in European tech, a boring, reliable ERP provider that runs the back offices of 90% of the world's largest companies. People buy SAP because they think it's a defensive moat, but the reality we are seeing today challenges that entire narrative. SAP is no longer a defensive play. It is a high-beta cloud transformation story that is increasingly sensitive to the same macro pressures as its American rivals like Salesforce or Oracle. The sell-off was exacerbated by the fact that many investors using online investing platforms or self-investing strategies had placed SAP at the core of their stable growth buckets. When that stability breaks, the exit door gets very crowded. If you look at the trading volume today, it is nearly triple the daily average. This isn't just retail panic. We are seeing major reweighting from Fidelity Wealth Management and other institutional desks. The pressure is coming from a very specific technical nuance that CEO Christian Klein highlighted during the call. SAP is closing a record number of mega deals, massive multi-year transformations for global enterprises. While these are objectively good for the long-term health of the business, they come with a back-end loaded revenue ramp. In simpler terms, the big money from these deals won't show up on the balance sheet until 2027 or 2028. For a market that lives and dies by the next 90 days, that's a lifetime away. Furthermore, there is a growing concern regarding the impact of government contracts. SAP has been aggressively pursuing public sector deals, but many of these now include termination for convenience clauses. Under standard accounting practices, these contracts cannot be fully counted toward the current backlog because the customer can theoretically walk away. This shaved about a full percentage point off the reported growth figures. It's a classic case where the business is fundamentally healthy, but the accounting and the timing of the revenue don't align with the market's appetite for instant gratification. Let's talk about the competition for a second. If you are using a Robinhood trading platform or an interactive brokers platform to watch the sector, you'll see that the contagion is spreading. When the leader of European enterprise software warns of a cloud slowdown, it casts a shadow over the entire ecosystem. Investors are starting to wonder if the AI boom is actually cannibalizing traditional software budgets. SAP insists that AI is a tailwind, claiming it's included in two-thirds of their new cloud orders, but the market is skeptical. The fear is that generative AI might allow companies to build their own bespoke internal tools rather than paying millions for a standardized SAP suite. Comment below how many shares of SAP you currently hold, or if you are planning to buy this dip. I want to see if you think this 16% drop is an overreaction or a long overdue reality check. To understand where SAP is going, we have to look at what they actually do today. They have spent the last 5 years trying to move their massive on-premise customer base, companies that run their own servers, into the SAP S/4HANA cloud. This is a brutal, expensive transition. It's not like upgrading the software on your phone. It's like performing a heart transplant on a Fortune 500 company while they are running a marathon. The company's business model has shifted from selling one-time perpetual licenses to a subscription-based Cloud ERP model. This is supposed to make their revenue more predictable, which is why 86% of their revenue now comes from recurring streams. But as we saw today, predictable revenue doesn't mean predictable stock prices if the growth rate of that revenue starts to trend downward. Looking at the broader macroeconomic picture, SAP is also fighting a headwind from its home base. The German economy has been stagnant, and as the largest component of the DAX 40, SAP often carries the weight of European industrial sentiment on its shoulders. When manufacturing firms in Germany or the US pull back on spending due to higher interest rates or trade uncertainties, SAP's digital supply chain and spend management modules are the first things to see a slowdown. This isn't just a software problem, it's a global trade problem. Now let's pivot to the future outlook, because this is where the opportunity might be hiding. Despite the carnage, SAP's operating profit actually grew by 27% in the fourth quarter. They're becoming a leaner, more profitable machine. They also announced a massive €10 billion share repurchase program that starts next month. This is management's way of saying, we think the stock is cheap. If you are an investor looking for investment help or exploring investing sites, you have to weigh this. Do you trust the CFO's vision of a 2027 revenue acceleration, or do you believe today's 16% drop is the start of a multi-year decline? There are two likely scenarios for the rest of 2026. In the optimistic scenario, the mega deals that are currently clogging the backlog begin to ramp up faster than expected. If SAP can show even 1% improvement in cloud backlog growth by the mid-year report, we could see a violent short squeeze back towards the €200 level. The reality of their 29% operating margin is hard to ignore. This is still a cash printing machine. They are targeting €10 billion in free cash flow for 2026. For a company with their market cap, those are serious numbers. In the pessimistic scenario, the termination for convenience clauses and the slower revenue ramps are just the beginning. If AI continues to disrupt the seats-based pricing model, where companies pay per employee using the software, SAP's traditional core could be in trouble. If employees become 50% more productive with AI, companies might need 50% fewer seats, which would be a catastrophic hit to SAP's subscription revenue. This is the hidden reality that the bears are betting on today. For those of you managing a Schwab Intelligent Portfolio or using SoFi Active Investing, today is a reminder that even the most stable tech giants can have black swan moments. SAP was the darling of the European market for the last 2 years, consistently outperforming the US tech sector. That outperformance created a bubble of expectation that finally popped this morning. The reality of the transition is simply taking longer and costing more than the perfection the market had priced in. In summary, the central insight here is that SAP's fundamental business health is actually quite strong, beating on profit and cash flow, but its momentum metrics failed the test. The market is punishing the timing of the revenue, not the existence of it. We saw a conflict between a management team playing a 10-year game and a market playing a 10-minute game. The 16% drop reflects a total reset of the growth narrative for 2026. Whether you are looking for fidelity ETFs that hold SAP or considering a direct individual brokerage play, the key takeaway is that the easy money in SAP's cloud transition has been made. From here on out, it's a grind. The company has to prove that it can not only sign mega deals, but also turn them into cold, hard cash faster than the current guidance suggests. The expectation was a smooth, upward curve. The reality is a jagged, difficult climb. As we wrap up, remember that volatility like this is often where the most significant long-term wealth is created or lost. SAP remains the backbone of global commerce, but today it proved that even the backbone can feel the strain when the weight of expectation